Hi, I'm Andrei Hall, President of Hall Wealth Management. You may have some concerns about your investments and retirement portfolio amidst today's global uncertainty. My goal is to offer some context and reassurance. First, a quick review and some perspective. No doubt the Russian attack on Ukraine poses a large global threat. However, it's very important for American investors to know that we have a resilient economy that historically holds steady throughout many similar crises. What has history taught us about past conflicts? Historically, they have not adversely impacted markets for long. Here's a handful of events we can point to. Most extreme examples are the Japanese attack on Pearl Harbor, negative 19.8% over 143 days, essentially a bear market at almost 20%. Market return 7.3% in the 12 months following. Least extreme example, JFK assassination, minus 2.8% one-day drop. Market return 27.8% in the 12 months following. While corrections in bear markets are painful, they are part of investing. We've rebounded significantly at times, and those who stayed the course have been rewarded. Staying the course can be tough, but let's look at the best way to weather it. Invest with intellect, not emotion. Typically, the best course of action during periods of market uncertainty is to stay invested for the long term. Don't attempt to time the market. Brace for short-term turbulence. The market reaction is typically swift, followed by recovery. Keep an eye on your long-term plans. Diversification is exceptionally important. Adequately diversify your investment portfolio to protect against the unknown. We're going to spend some time on this in the next slide because it is so important. Bear markets and corrections are common and potentially can be healthy in the long term. Only 6 of the last 94 years have we experienced a market down by 20% or more. So 6 out of 94 years. That means that 88 years we were not down 20% or more. Patience can help us win in the long term. We need to allow market swings to play out as a normal part of investing, even if we don't like it, and none of us like it. Buy low, sell high. For some, there can be important opportunities at inflection points. Now can be a good time to buy some beaten up stocks or sectors. We'll focus on remaining diversified for now because frankly, it's so important for maintaining your sense of equilibrium while also safeguarding against inflation. Uncertain times call for a portfolio tune-up, and these are some of the things we can discuss. Rebalancing. Market highs and downturns are great times to assess whether your overall allocations can and should be tweaked. Inflation-proof your portfolio with assets outside of the market. Real estate, REITs, precious metals, hedge funds, commodities, art, collectibles, and wine. Beware of lack of liquidity in certain asset classes. Consider adding exposure to these asset classes through ETFs or mutual funds, which feature daily liquidities. Short durations of your bond portfolios. Explore Treasury inflation-protected securities, TIPS, or government securities, savings bonds. Consider adding protected assets like annuities or structured products to dampen volatility. Think about careful and tactical use of inverse ETFs. Key insights. Running up to the 2020 bear market, triggered by the pandemic, we experienced an unprecedented 12 years period of prosperity and growth. As it relates to investing, that really is unusual. In the last decade, we have been lulled into unrealistic expectations since stocks have risk. There can be swings from gains to losses. Let's have a look at 94 years of the S&P 500 annual results from 1928 to 2021. How many times has the market been down and by how much? Interestingly, the market has been negative 25 of 94 years, around 27% of the time. Let that sink in. Negative almost a third of the time. 20% and 15% or more 6 times. 10% or more 12 times. 5% or more 19 times. And these are calendar years. Negative years are common and part of the challenges of being in stocks. As we've seen with the previous slide, the rewards can make all the difference in your efforts to create wealth. In each decade, we remove the best 10 days in the market. Investors who didn't flinch with their allocations to stocks, cumulative returns of 17,715%. Investors who were out of the market on those 10 best days per decade, cumulative returns of only 28%. So look at that. 17,717% versus 28%. Serious impact to not stay in the course. Downturns can really challenge us emotionally. Hanging in there and following a plan through market turmoil is tough. Emotions tell us we must do something to remove the source of the pain. Leave the market and sell, sell, sell. Emotions are telling us we need to time the market. Unfortunately, unless you have a time machine, it's impossible. While selling may solve our needs to avoid the pain of a downturn, it begs the question, when do we get back in? Here we look at an interesting exercise, what would happen if we stayed invested through market ups and downs versus pulling money out and hence missing the bounce back up. Thanks for taking time to join me today. If you're feeling anxious or simply curious about how your portfolio stacks up against inflation and ongoing market swings, let's address your concerns with a conversation.